Welcome to the deep dive. I want to start today by having you just picture a very specific kind of business.
Yeah, picture a really massive one,
Right, exactly. Imagine a company that has been growing its operating profits by over 38% annually.
which is just a wild number in this macro environment.
It is. It boasts 23 consecutive quarters of revenue growth. It is sitting on a massive pile of cash and operating with zero debt, absolute zero debt on its balance sheet.
A literal perfect machine.
Right. By almost every traditional metric of corporate success, you'd look at this company as an absolute powerhouse. But here's the hook. If you look at its stock performance, it dropped 25% in a single calendar year.
It is honestly the ultimate modern market paradox.
Yeah.
And it's exactly why we are dissecting this specific case today.
Exactly. Because how does a company do everything seemingly perfectly hit every major financial milestone, operate in the hottest sectors of the economy, and still get so brutally punished by the market?
The math just doesn't seem to math for most people looking at it.
Right. So our mission for this deep dive is to unravel that exact mystery for you. We are exploring a comprehensive stock story and financial analysis of Persistent Systems Ltd.
Usually just called persistent in the industry.
Yeah, persistent. Now let's be crystal clear right out of the gate here. Our goal is not to give you investment advice.
No, definitely not.
We're not analyzing this to tell you whether you should buy or hold or short the stock.
Oh.
Instead, we want to use Persistent as a masterclass.
They really are arguably the absolute perfect lens right now to understand the actual brutal mechanics of the global IT services industry.
Yeah, and the hard reality of how companies are actually trying to monetize artificial intelligence. Not just the hype, but the real monetization.
And the hidden structural risks that are just embedded deep within these offshore tech models. Because if you look at their portfolio, they are sitting squarely at the intersection of literally every major technology buzzword you read about today.
Cloud computing.
Yeah, cloud AI, enterprise modernization, digital transformation, they do it all. They are building the infrastructure for the future.
But despite operating in what should be an endless gold rush, they are facing intense real-world challenges, structural challenges that are threatening the very foundation of their model.
So today, we are going to look past all that corporate jargon, past the buzzwords, and help you understand the why behind those numbers. We need to see what the financial engine actually looks like under the hood.
And more importantly, what happens when that engine starts making some really strange noises.
Exactly.
Okay, let's unpack this. We need to start with the anatomy of this tech giant because they are essentially hiding in plain sight. What does Persistent actually do?
Right. Because if you pull up their press releases, they say they provide digital engineering and enterprise modernization.
Which frankly sounds like meaningless corporate speak generated by an algorithm.
It really does. It sounds like every other B2B brochure out there.
Yeah.
But they aren't just an IT help desk. They aren't just fixing the office router or setting up your email servers.
No, to really grasp the scale of what they do, I want you to imagine you are the chief information officer of a massive 100-year-old global bank.
Okay, high stakes.
Very high stakes. Your entire core payment processing system, the system handling billions of dollars every single day, is running on mainframes built in the 1980s.
Held together by digital duct tape, basically.
It's literal duct tape. The original programmers who wrote the code have all retired or passed away, but you cannot simply turn the bank off for a weekend to install a new system.
You'd cause a global financial meltdown.
Exactly. So it's like trying to change the engines on a Boeing 747 while it is currently flying over the Atlantic Ocean.
While it's full of passengers.
Right. You have to uncouple the old legacy systems, migrate the data to a modern cloud architecture, implement state-of-the-art cybersecurity, and train new AI tools to monitor it all.
And you have to do all of that without dropping a single live credit card swipe.
That 747 analogy is exactly the scale we are talking about with Persistent. That is true enterprise modernization. It's high-stakes, incredibly complex digital surgery on a live patient.
And they are selling these services to some of the most demanding buyers on the planet.
Over 350 major enterprise clients.
Spread across 21 different countries. We are talking primarily massive players in banking, financial services, insurance, the BFSI sector.
As well as immense healthcare networks and global telecom providers.
Highly regulated industries, where a botched migration or a few minutes of downtime literally costs millions of dollars.
And brings in massive government fines.
Right, so that level of responsibility requires an immense scale of human capital. The size of Persistent is staggering when you actually look at the logistics of their workforce.
Because it's a normie.
It is an army of highly skilled tech talent. We're looking at a base of over 24,500 employees. And some of the more recent operational metrics actually show them scaling well past 26,500 employees.
26,500 engineers. That is a massive payroll.
And they aren't just sitting in one giant campus in Silicon Valley. They are distributed across 18 to 21 different countries.
Managing that alone, coordinating complex multi-year engineering projects across 24 time zones and multiple languages is just a logistical marvel.
And it brings in serious, undeniable revenue. Look at their fiscal year 24. They pulled in over $1.186 billion annually.
Over $1 billion.
Yeah. And the momentum isn't slowing down either. Just in quarter 3 of their fiscal year 26 alone, they hit $422.5 million.
So they are operating well past the billion-dollar scale and accelerating rapidly. But to really understand their position, we have to look at the sandbox they are playing in. We need to talk about their total addressable market.
To TAM.
Yeah, the TAM.
The TAM is where the true scale of the opportunity really comes into focus for them. For digital engineering and enterprise modernization, the global TAM is estimated to be between $500 billion and $700 billion by 2025.
That is a staggering amount of money floating around.
It is. Let's break down that pie because it's not just one homogeneous market. First, you have cloud and infrastructure. This is the physical and logical migration of data centers to multi-cloud setups.
And that subsegment alone is, what, 200 to 300 billion? Exactly. Then you have AI and data analytics, which includes implementing generative AI into corporate workflows. That's another 100 to 150 billion.
Okay.
Then there is software product engineering, adding another 100 to 150 billion. Add in enterprise IT security and intelligent automation. And you quickly see why this is a $500 billion playground.
Okay, let's pause here because here is the massive, glaring aha moment for you listening right now. We just established that persistent is a titan, right?
A billion-dollar titan.
Right, pulling in over $1 billion, employing 26,000 people, executing these complex digital surgeries. But when you compare their massive revenue to that $500 to $700 billion market,
They are tiny.
they have less than a 1 to 2% penetration in this space. They are giant, and yet they are barely a rounding error in the broader market.
They're just scratching the surface. What's fascinating here is why that market is still so incredibly open.
Right, because you would intuitively think that by now, every major Fortune 1000 company is already fully in the cloud, running sleek, efficient tech stacks. But the data shows a radically different reality. Between 60 to 70% of enterprises globally are still running on 70% or more legacy applications.
70% legacy. That's wild.
Less than 25% of Fortune 1000 companies have actually completed their cloud migrations. It is an absolute gold rush right now.
And the vast majority of the gold is still buried deep in the ground. But hold on, why is it taking so long? We have been talking about the cloud for what, 15 years?
Easily 15 years, yeah.
So why are 75% of the biggest companies in the world still dragging their feet on finishing these migrations?
It really comes down to friction and fear. Remember your 747 analogy earlier. If you are the CIO of a bank, migrating your core ledger to the cloud isn't just an IT upgrade.
It's an existential risk to the entire business.
Exactly. These modernization cycles take 2 to 5 years on average. They require immense capital expenditure upfront. And crucially, there is a massive global skill gap.
Meaning they just can't hire enough people themselves?
Right. Companies simply cannot hire enough specialized software engineers and cloud architects to do this work internally. The talent just doesn't exist in the open market in those quantities.
Which is exactly why they have to turn to specialized, massive global firms like Persistent.
Precisely.
Which perfectly brings us to the engine of their profitability. We see the massive market, we see the demand, and we see the talent pool they have amassed. So how do the unit economics actually work?
How do they make the money?
Yeah, how do they turn deploying 26,000 engineers into a 38% profit growth engine? The fundamental revenue model for Persistent is fee-for-service contracts.
But they aren't just charging by the hour to reset passwords anymore.
No, they are actively shifting their entire portfolio away from those smaller commodity-like IT support services. They are aggressively targeting larger, highly complex, multi-year engineering engagements.
And that distinction is vital. When you are doing basic IT support, it is a brutal race to the bottom on price.
There's always someone willing to do it $1 cheaper.
Always. But when you are re-architecting the core data pipeline for a multinational healthcare provider to ensure it complies with shifting privacy laws.
You can command absolute premium pricing.
Exactly. And the financial flex that results from this strategy is honestly jaw-dropping. We're looking at a trailing 12-month revenue of nearly $1.6 billion.
Which represents an 18.5% year-over-year top-line growth.
The top-line growth is great, but let's talk about the bottom line, specifically their return on equity, or RO. They boast a long-term ROE of 21.92%.
In a heavy human capital IT services sector, returning nearly 22% on equity is a massive achievement.
It's huge. And they pair that with an operating profit growth of 38.08% annually.
Now, wait a minute, let's look at the math there. Their operating profit is growing at roughly 38% a year, but their net sales, their top-line revenue is growing closer to 28% historically.
Right.
How exactly does a services company grow its profit substantially faster than it grows its actual sales?
This is the absolute magic of operating leverage. And it's crucial to understand how these IT service firms actually make their money. Think about the fundamental structure of their costs.
Okay.
Their biggest variable cost, obviously, is people. Salaries, bonuses, benefits for 26,000 engineers. But they also carry massive fixed costs.
Like maintaining global data centers.
Yeah, the data centers, enterprise cloud service agreements, massive corporate office leases across 21 countries. As their revenue scales up, as they sign a $50 million deal instead of a $5 million deal, those fixed costs stay relatively flat.
Right. They don't need to build a second global headquarters just because they signed 5 new telecom giants. The infrastructure is already paid for.
Exactly. So every new dollar of revenue that comes through the door doesn't just maintain the same profit margin. It brings a mathematically higher percentage of profit because the base operating costs are already covered.
So this operating leverage is what allows the profit growth to vastly outpace the sales growth.
Yes. And what makes this particular financial engine so uniquely resilient is that they have achieved this scale with zero debt.
That is just unheard of in massive tech expansions.
They have no massive interest payments eating into their cash flow. They are funding this aggressive global expansion entirely through their own organically generated cash.
Zero debt is an incredible safety net, especially when we look at how volatile the broader tech sector can be. But here is where it gets really interesting. And this might be one of the most counterintuitive data points we've found in this whole dive.
Oh, the AI numbers.
Yes, let's talk about artificial intelligence. Because the prevailing narrative in the market right now is that AI is a massive, uncontrollable capital sink.
Right. We constantly hear about companies spending billions on R&D, hoarding NVIDIA chips, all while trying desperately to figure out how to actually use the technology to make a dollar.
But Persistent is completely flipping that narrative. Their AI platform monetization, specifically what they classify as tool-driven pricing, actually added 150 basis points to their margin in Q3 of fiscal year 26 alone.
What's fascinating here is the stark contrast with almost every other tech giant's current earnings call. Everyone else is apologizing to investors for how much AI is costing them, promising it will pay off in a decade.
And Persistent is already successfully using it to widen their margins today.
They are actively shifting their service mix to higher value technology-enabled offerings.
Let's break down tool-driven pricing for a second, because that's a massive shift in how IT services traditionally operate. Traditionally, they bill for time and materials.
Right. If a project takes 100 engineers 6 months to build a client, pays for 100 engineers for 6 months.
But tool-driven pricing implies they're leveraging their own internal AI platforms to accelerate that work.
Precisely. They're using AI coding assistants, automated testing suites, intelligent debugging tools to deliver the final product vastly faster.
But instead of passing all those cost savings directly back to the client by billing fewer hours,
they transition to outcome-based pricing. They say, we will deliver this modernized platform for X million dollars because their internal AI tools allow their engineers to do the work. In a fraction of the time, their internal cost of delivery plummets.
So 150 basis point margin improvement means they essentially increase their core profitability by 1.5% in a single quarter, simply by injecting AI efficiencies into their own internal workflow.
They aren't just selling AI as a theoretical concept to their clients. They are actively using it to generate real, software-like economics within a human capital business.
So they have an ocean of a market, they have massive scale, and they have an incredibly tuned profit engine that is actually benefiting from AI today.
If you stop the analysis right here, they look invincible.
They really do. But in the hyper-competitive world of global IT success, just paints a massive target on your back. What is actually stopping an upstart firm in Eastern Europe or a new tech hub in South America from standing up 5,000 engineers and undercutting persistence pricing tomorrow?
What is their actual moat?
Yeah, what is the real mode here?
That is the multi-billion-dollar question. And our analysis breaks their competitive advantage down into two distinct categories: the proven moat and the imagined unproven moat.
Let's start with what is undeniably real.
Their proven moat relies almost entirely on their deeply entrenched offshore cost advantage. And the numbers validate this entirely. They operate with a 30.39% gross margin and a 12.43% net profit margin.
In the cutthroat, heavily commoditized world of IT services, those are incredibly fortified numbers.
They are.
Wait, hold on. A 30% gross margin is fantastic, but the gap between offshore engineering costs in India and onshore costs in the US or Europe has been steadily shrinking for a decade.
That's true. The wage arbitrage is shrinking.
So is that 30% margin actually a sustainable moat? Or are they just coasting on legacy contracts? Anyone with capital can go try to hire cheaper talent on paper, right?
That is a very valid pushback, but it misses the complexity of what Persistent has actually built over 35 years. Yes, the pure wage arbitrage, the simple fact that a developer in Pune costs less than a developer in Palo Alto is shrinking.
Right.
But the real advantage, the actual impenetrable moat, is the decades of highly specialized infrastructure they have built around that talent.
It's not just the people, it's the system.
Exactly. It's the sophisticated training pipelines that take thousands of raw university graduates every single year and turn them into deployable enterprise engineers.
Okay, I see.
It's the intricate middle management structures, the proprietary project management methodologies, and a very specific, deeply ingrained corporate culture that knows exactly how to seamlessly manage distributed teams across 21 different time zones.
Without dropping the ball on a critical bank migration. So it's the difference between buying a fast car and knowing how to run an entire Formula One racing team.
That is the perfect way to look at it.
Yeah.
Anyone can buy the car, but Persistent has the entire pit crew, the telemetry engineers, and the logistical supply chain down to an absolute science.
You cannot quickly replicate a 35-year history of building offshore execution capability. You can't just throw money at it and expect to have a functioning, globally distributed 26,000-person engineering culture overnight.
Which is exactly what has fueled their phenomenal 32.8% profit compound annual growth rate over the last 5 years. It's an execution mode.
Okay, so the execution moat is real and it's spectacular. But let's talk about the unproven moat, because if you look at their marketing brochures, if you listen to their executives at conferences, they heavily promote their proprietary persistent Gen AI hub.
Oh, yes, they do.
They are aggressively pitching this as their massive, insurmountable technological advantage for the future. They want the market to believe they aren't just a services firm, but an AI product company.
And this raises an important question.
Yeah.
And it's exactly where I want to encourage you, the listener, to really engage your critical thinking.
Because when we dig into the actual financial reports, and the rigorous data provided this generative AI advantage is explicitly categorized as weak or emerging.
Why? Because there is absolutely no hard market traction data provided. There are no concrete customer adoption metrics.
There are no specific segmented revenue contribution numbers provided to back up the claim that the Gen AI Hub is actually functioning as a massive competitive moat.
Exactly. So what does this all mean? Are they just faking it? It doesn't mean the product is bad, but it means we have to rigorously separate corporate positioning from validated financial scale.
Right now, every single tech company on the face of the earth is claiming to have a proprietary AI advantage. It is a required buzzword to keep your stock price afloat.
But Persistent's current, very real revenue growth, that impressive 17 to 18% year-over-year jump, is fundamentally coming from their traditional consulting, their cloud migrations, and their software engineering work.
It is coming from the 26,000 human beings executing complex projects, not from a runaway viral success of a proprietary standalone AI software product.
The Gen AI Hub might become a massive moat in the future, but right now, looking strictly at the spreadsheet, it is entirely unproven as a standalone revenue driver.
That is a crucial, vital distinction to make. It is the difference between what is actually paying the bills today and what the marketing department hopes will pay the bills tomorrow.
So looking at what is paying the bills, where does the future growth actually come from for a company that is already making well over $1 billion?
Yeah, how do you double a billion-dollar services firm?
If you look at their forward guidance and strategic roadmaps, the game plan for the next 5-10 years is built on two primary pillars. The first pillar is deeper penetration and massive ecosystem expansion.
They have 23 consecutive quarters of momentum, and they are leveraging that to push even deeper into their core verticals, specifically doubling down on healthcare and the BFSI sector.
And the strategic mechanism they are using to achieve that penetration is fascinating. They are actively positioning themselves as an ecosystem orchestrator.
An ecosystem orchestrator. What does that actually mean in practice?
If you look at the macro layout of the tech world today, the ultimate power is increasingly concentrated in the hands of the massive hyperscalers. Amazon Web Services, Microsoft, Azure, Google Cloud.
These entities own the physical infrastructure of the internet.
Right. And Persistent's strategy isn't to try and build a competing cloud to fight AWS. It is to deeply partner with them.
They want to be the specialized elite experts who walk into a massive corporation, hold the CIO's hand, and say, we will co-innovate with you and the hyperscalers to migrate your incredibly delicate legacy systems perfectly onto their cloud.
They act as the vital connective tissue between the enterprise client, who is terrified of migrating, and the hyperscaler who desperately wants the client's computing workload.
They are the Sherpas guiding the enterprise up the AWS mountain.
I love that. Yeah.
And the second pillar of their growth strategy is premiumization. It's a bit of a buzzword, but the mechanics behind it are incredibly solid.
It basically means aggressively moving up the value chain.
They want to stop competing for lower-tier basic IT maintenance contracts and exclusively target massive premium enterprise transformation deals where they can dictate higher billing rates.
If we connect this to the bigger picture, there are massive, unavoidable structural tailwinds driving this premiumization strategy. Think about the global landscape of data privacy regulations.
You have GDPR in Europe, which is incredibly stringent.
You have HIPAA for healthcare in the United States, which carries massive penalties for data breaches.
These evolving tightening regulations essentially force massive companies to constantly upgrade their cybersecurity, their data integration pipelines, and their cloud storage architectures.
A multinational hospital network cannot rely on cheap offshore IT support to handle compliant, heavily regulated patient records. The stakes are simply too high.
Persistent is positioning itself to command premium pricing precisely because they have the deep, validated domain expertise to navigate these heavily regulated industries safely.
And the market is clearly responding to this positioning. They are currently recognized as the fastest-growing IT services brand globally, boasting a massive 22% growth in overall brand value.
Okay, let's take a breath and recap where we are. Up until this exact moment in the deep dive, we have painted a picture of a company that is absolutely crushing it.
They are operating in a $500 billion market.
They have stellar margins, a 30% gross advantage. They have 23 quarters of relentless growth.
Zero debt.
They are leveraging AI to boost margins today, and they are successfully moving up the value chain to charge premium prices. It sounds like the perfect company.
But as we stated at the very top of the show, their stock dropped 25% in a single calendar year.
So the narrative we've built so far is obviously incomplete. We have to rip up the floorboards and look at the structural cracks. What is actually threatening this machine?
The very first major quantifiable threat is a direct regulatory hit stemming from India's new labor codes.
This is a critical, highly consequential point that often just gets buried in the footnotes of financial reports.
It really does. The Indian government has been implementing new comprehensive labor codes that fundamentally change the way companies have to account for provision and pay out employee benefits.
Specifically, this heavily impacts the calculations regarding gratuity, which is a mandatory lump sum payment given to employees after a certain tenure, and leave encashment policies.
For a company that employs tens of thousands of people in India, this isn't a minor administrative tweak. It is a massive recalculation of their core liabilities.
And this wasn't just a theoretical risk debated by lawyers in boardrooms. The Q3 FY26 financial numbers showed that this regulation hit Persistent like a freight train.
They took a one-time 230 basis point drop directly on their EBIT margin. That is their earnings before interest and taxes.
Because of this sudden regulatory shift, their reported EBIT came in at 14.4% instead of the 16.7% they would have achieved without it.
To contextualize that, for the broader business model in a heavy human capital services business, where your net profit margin is hovering around 12 or 13%, losing 2.3% off your operating margin literally overnight simply because of a government regulation, is a massive, highly disruptive hit.
It is a structural cost increase. It's not a bad quarter of sales where they miss their targets. It is a permanent foundational change to the baseline cost of doing business in their primary operational hub.
And that regulatory hit bleeds directly into the second, much larger structural threat: wage inflation versus pricing power.
We established earlier that Persistent's primary proven competitive moat is its offshore cost advantage, leveraging that incredible deep talent pool in India.
But what happens to the math of the business when that exact talent pool suddenly gets significantly more expensive?
That is the squeeze. The data outlines a very real, very dangerous ripple effect here. The global competition for elite tech workers, especially engineers skilled in cloud architecture and AI integration, is incredibly intense.
If Indian IT talent costs rise by 5 to 10% annually, which is highly probable given the current demand dynamics, Persistent's baseline costs skyrocket.
Now, normally a business would just pass those increased costs onto the consumer by raising prices.
But the broader global IT services market remains fiercely competitive.
Right. If Persistent goes to a major bank and tries to raise their contract rates by 10% to cover their higher Indian payroll, the bank might just walk away. They will sign with a competitor who is willing to take a lower margin to win the business.
If Persistent is forced to pay their coders 10% more, but they fundamentally cannot raise their billing prices because of market competition, that money comes straight out of their gross profits.
The 30% gross margin moat begins to evaporate.
Which raises profound questions about the long-term sustainability of the offshore arbitrage model entirely.
But even that threat pales in comparison to the third and, frankly, most existential crack in the foundation.
Yeah.
The AI paradox.
Oh, this is the big one.
We spent time earlier talking about how brilliant Persistent is for using AI internal tools to boost their margins by 150 basis points. They are leaning into the technology.
But there's an ultimate terrifying irony embedded here.
Yeah.
The very technology they are selling and implementing could fundamentally disrupt and destroy their entire core business model.
It is wild to think about, but the logic is inescapable. Generative AI, agentic AI, and advanced automation platforms are accelerating at a breakneck pace.
They are getting exponentially better at writing complex manual code, autonomously testing software for vulnerabilities, and debugging massive enterprise systems.
If we look down the timeline, if enterprise clients can increasingly just utilize AI, low-code, or no-code platforms themselves,
Or if the hyperscalers build these autonomous coding agents directly into their cloud offerings.
those massive enterprise clients simply aren't going to need to hire an external army of thousands of offshore developers from companies like Persistent to do the heavy lifting.
Let's go back to your Boeing 747 analogy. Right now, Persistent is providing the thousands of highly trained human mechanics needed to rewire the plane mid-flight.
But what happens when the airline owner can just buy a fleet of highly advanced AI autonomous drones that can do 60 or 70% of that complex rewiring entirely on their own?
For a fraction of the cost without needing breaks, benefits, or leaving Cashman.
If the sheer volume of manual coding and testing drops precipitously because AI is doing the work, the massive human capital advantage that Persistent has spent 35 years building, that logistical mastery of 26,000 employees, suddenly flips from being their greatest asset to their heaviest liability.
How do you sustain $1 billion in top-line revenue when the core commodity you are selling, human engineering hours, is vastly depreciated by an algorithm?
It is the innovator's dilemma playing out in real time.
And this existential anxiety perfectly explains the fourth major crack in the foundation: the valuation disconnect.
This is where the narrative of the great business collides violently with the reality of the stock market. Let's look at the specific stock metrics. Prior to the massive drop, Persistent was trading at a price-to-earnings, or PE ratio, of 50.6.
For context, the broader market average PE for the sector was hovering around 23x.
A PE of 50.6 means that investors are willing to pay over $50 for every single dollar of current earnings the company was generating. That is an astronomical premium.
You only pay that kind of multiple if you believe the company is going to double or triple its earnings in a very short time frame.
If we connect this to the bigger picture, a 50.6 multiple means the stock was priced for absolute flawless perfection. The market was expecting massive, uninterrupted, exponential future growth.
But when we look at the actual forward-looking analyst estimates, the reality is sobering. The consensus estimates suggest that Persistent's earnings are only projected to grow at about 15% annually over the next 3 years.
Let me make sure I am grasping the magnitude of this disconnect. The broader market's forecasted growth is around 21%.
Right.
Persistent's expected growth is only 15%. They are literally projected to grow slower than the market average over the next 3 years.
Yet their stock was priced at more than double the market average multiple.
The math simply does not support the hype.
It was a classic valuation bubble driven by the AI and cloud buzzwords we discussed at the beginning.
And when the market inevitably realizes that a company priced for flawless exponential growth is actually facing severe labor code margin, hits looming wage inflation, flat pricing power, and the ultimate existential threat of AI replacing their core business.
The bubble violently bursts. That severe valuation disconnect, the gap between the 50x multiple and the 15% growth reality, is the primary driver of the massive 25% stock drop. The stock had to collapse to reconcile with reality.
It's fascinating and a little terrifying how quickly the narrative changes when you strip away the buzzwords and look at the raw expectations versus reality.
Absolutely.
Now we need to pivot to a crucial internal dynamic, which leads us to leadership governance and the employee disconnect. Because ultimately, a massive enterprise with 26,000 employees isn't just numbers on a spreadsheet.
It is driven by the people at the top making the decisions and the people at the bottom executing the work.
Let's introduce the men steering this massive ship. First, we have Dr. Anand Deshpande. He is the founder. He has been at the absolute helm of the company for 35 years, and he currently holds a massive 30.65% ownership stake.
That stake is worth billions. That is a founder who has immense, undeniable skin in the game.
And operating right alongside him, you have Sandeep Kalra, who stepped into the CEO role in 2020.
By all accounts, Kalra is credited with really revitalizing the business operations and aggressively pushing the company past that monumental $1 billion annual revenue mark.
When you look at the top-level corporate governance structure they've built, they look utterly fantastic on paper. They actually won the prestigious Best Board Award in Extel's 2025 survey.
They feature highly experienced, high-profile independent directors. They boast an average board tenure of nearly 6 years, which implies great stability, and they have stellar ESG ratings for their environmental, social, and governance practices.
From the perspective of an institutional investor ticking boxes, their governance is pristine.
Okay, but here is the shocking contradiction. And honestly, when reviewing all the data for this deep dive, this might be the most surprising, glaring red flag in our entire stack of information today.
Despite the prestigious awards, despite the pristine ESG ratings, despite the 23 consecutive quarters of revenue growth, the actual employee approval of the executive team is abysmally low.
It currently sits at a staggering 25%.
That means 75% of the workforce, 3 out of every 4 employees, does not approve of the executive team.
And you might immediately think, oh, well, that's probably just the massive influx of new hires who don't understand the legacy culture yet.
No, the data shows that even among long-tenured employees, the veterans who have been there for years, the executive approval rating is only 33%.
This raises an incredibly important question, and it is perhaps the most critical internal structural issue the company faces.
Yeah.
We have to ask, how sustainable is a heavy human capital IT business if the vast majority of the rank-and-file employees are deeply disillusioned with leadership?
Think about everything we have discussed. The entirety of Persistent's competitive moat relies entirely on organizing, managing, motivating, and retaining tens of thousands of offshore tech workers.
If 75% of your core operational talent is unhappy with the C-suite, this is a massive, blaring, early warning signal for severe attrition.
And attrition is an absolute nightmare scenario for an IT services company. It's the ultimate margin killer.
If your best, most experienced cloud architects and coders leave because they are unhappy with leadership, you have to spend massive amounts of capital to recruit new ones.
You have to spend months of unbillable time training them on proprietary systems.
And crucially, you probably have to pay the new hires significantly more just to get them in the door due to the wage inflation we discussed earlier.
That dynamic circles right back around to crushing your profit margins. Not to mention, severe turnover directly impacts your ability to reliably deliver those complex, high-stakes, multi-year modernization projects for your massive banking and healthcare clients.
If the team rewiring the 747 mid-flight keeps quitting, the plane is going to crash.
Exactly. It creates a brutal domino effect that destroys value from the inside out.
Yeah.
The financial numbers we read, the 38% profit growth, the $1 billion in revenue, those numbers are entirely backward-looking.
They tell us what the employees achieved last quarter or last year.
But employee sentiment. Employee sentiment is a leading indicator. It tells us what is likely to happen to the project delivery timelines and the profit margins next quarter.
You simply cannot maintain a 38% profit growth engine if the thousands of people actually shoveling coal in the engine room are deeply unhappy and threatening to walk out the door.
The disconnect between the billionaire founders winning boardroom awards and the line-level coders actually executing the work is a massive, looming structural risk.
It really puts the entire picture into a stark, sobering perspective.
Which brings us to the final reality check summarizing exactly where the company stands today. We've looked at the incredible strengths, the massive market, the AI margin boosts, and we've heavily dissected the regulatory cracks, the wage inflation, the existential AI threats, and the internal employee turmoil.
Let's recap what actually happened when all these forces collided. The company had an objectively stellar quarter recently. Quarter 3 in fiscal year 26 was a blockbuster on paper.
They posted $422.5 million in revenue, representing 17.3% year-over-year growth.
The core business generated so much excess free cash that they declared a very healthy interim dividend of 22 rupees per share.
If you just look at the raw operational spreadsheet, the business is fantastic.
Yet the reality check delivered by the broader market is incredibly harsh. As we mentioned at the very beginning, despite that stellar operational performance, the stock dropped a staggering 25% in calendar year 2026 and is currently down 13.72% year over year.
So why the massive disconnect? If we synthesize every single thread we've pulled today, the dots connect to form a very clear, undeniable picture.
The stock market is not a report card that grades you on your past achievements. It is a brutal voting machine that strictly prices in the future.
The market isn't giving them a trophy or a premium valuation just because they had 23 quarters of growth in the past.
Precisely. The market was looking at a stock that was priced for absolute flawless perfection, a PE ratio over 50. But then the market starts seeing the complex reality creeping in from the edges.
Institutional investors see the new Indian labor codes instantly eating a permanent 2.3% hole in the operating margin.
They see the undeniable demographic trends of wage inflation looming on the horizon in India, threatening to compress the 30% gross margin.
They look at the internal data and see the 75% disapproval rating from employees, and they immediately start modeling in the high costs of future attrition.
And most importantly, overarching all of this, they see the massive existential threat of generative AI potentially replacing the very manual coding hours that Persistent fundamentally relies on to generate its $1 billion in revenue.
The market simply spooked. The 50x valuation was far too high, far too fragile to absorb any of this complex bad news.
And so the price corrected aggressively violently to match the emerging structural risks.
It is such a powerful, vital lesson in corporate analysis. A great, highly profitable business does not automatically equal a great stock investment if the price you were forced to pay for that stock completely ignores all the underlying structural risks.
It's the ultimate cautionary tale of separating the business from the stock.
So let's bring this all home. What is the ultimate... For you, the listener, why did we spend all this time ruthlessly dissecting the mechanics of persistent systems?
We did it because this specific company is the absolute perfect lens through which to view the massive tectonic shifts happening in the modern tech economy today.
It shows us just how massive the transition to the cloud still is. Remember that staggering statistic that 75% of Fortune 1000 companies still haven't finished migrating? The work is still out there.
It shows us how AI is not just a massive cost center, but is providing real tangible margin boost today for the companies that actually know how to use it internally to drive efficiency.
But simultaneously, and perhaps most importantly, it exposes how incredibly fragile even the most successful, heavily entrenched offshore business models can be when they are faced with sudden government regulations, inevitable wage inflation, internal employee dissatisfaction, and the massive looming shadow of AI automation.
It is a profound reminder that in the technology sector more than anywhere else, the ground is always shifting beneath your feet.
A massive, highly profitable 35-year competitive moat can be fundamentally challenged and potentially rendered obsolete in a matter of just a few years by a fundamental shift in how software is conceptualized and written.
The game never stops changing.
Exactly. Now, before we officially wrap up this deep dive, my expert colleague has one final, highly provocative thought for you to mull over, something that builds on the existential threats we've discussed today.
I want you to really think about the ultimate trajectory of this entire industry. Right now, Persistent Systems is building its incredible growth story by acting as the highly paid expert guide.
They are helping other massive global corporations implement AI, modernize their data centers, and become vastly more computationally efficient.
They're the ones installing the smart autonomous systems. But as AI platforms, potentially even platforms like their own heavily promoted GenAI hub, become increasingly autonomous.
As these systems become fully capable of writing their own complex code, autonomously testing it for security flaws, and deploying it directly to the cloud without any human intervention.
Will we inevitably reach a tipping point? Will we reach a moment where these massive IT service companies have effectively automated their own client base out of needing them?
If you successfully build the perfect self-healing, self-coding AI infrastructure for your massive banking client, does that bank ever need to hire your 26,000 offshore employees ever again?
Does the tech snake ultimately and inevitably eat its own tail?
Now, that is a thought to keep you up at night. Does the tech snake eventually eat its own tail, automating away the very billions of dollars it relies on to survive?
A fascinating paradox to watch play out over the next decade.
Thank you so much for joining us for this deep dive. We hope you walk away with a much richer, vastly more complex understanding of the invisible forces and structural mechanics shaping the global tech world right now.
Keep looking past the buzzwords.
And as always, we highly encourage you to keep questioning the narratives and keep rigorously interrogating the numbers behind the hype. Until next time.